The really difficult thing about evaluating and deciding what to do about all the potential risks out there is doing it when you're not that worried about it. Welcome to the Retirement Answer Man Show. My name is Roger Whitney. This is the show dedicated to helping you not just survive retirement. We want you to rock retirement. And this is the last episode of this edition of thinking about long-term care risk. It's definitely one of those risks that you need to evaluate before it becomes apparent that you're going to have to deal with it. I think of the markets. I'm sitting here. It's Monday morning. The show comes out on Wednesday, and I'm looking at the futures, and we're down almost 1,000 points on the markets. That's one reason why I like to do the bear market themes when markets have come off a great year, which we did last month. Not that I predicted anything. I'm not saying that, but it's good to address potential risks when we are of sound mind and not dealing with them, because that leads to hopefully better decision making. And today, what we're going to do on the show, it's a really big show. We have Steve Cain coming back on to talk about hybrid policies for long-term care. We have Beach Walker, our head retirement coach in the Rock Retirement Club, talking about some coaching tips around long-term care. And then we're answering listener questions. So this is going to be a longer than normal show, but it should be pretty exciting. We'll get to it right after this message from our sponsor. So the show is sponsored by the Rock Retirement Club. And to give you an idea of a few of the things that we do in the club, this Thursday, tomorrow, Steve Cain is coming on into the club to do a live meetup with members. And what we did was we got illustrations of a traditional long-term care policy and a hybrid policy, the kind of policies that he's going to share with us today. And we are going to chat with him and go through these illustrations. They're on me and my wife. We figured we'd be the test dummies. And we're going to have an active, open discussion about how these policies work and walk through all the different components that need to be considered that are represented in this illustration. And then club members are going to be able to ask questions and put Steve on the spot to get a more robust understanding of how these things work. So we do those type of things with special guests all the time. And so tomorrow we're doing it with Steve so we can really dive in. And the cool thing is, if you can't attend live, all of these are recorded that you can listen to on a special private podcast that we have. So check out the Rock Retirement Club at rockretirementclub.com. So let's explore these hybrid policies with Steve Cain so we have a better understanding of how these work in the long-term care puzzle. Steve, if 1 week wasn't enough, you're back again to talk the exciting topic of long-term care.
Yeah. I mean, I can't believe you wanted this twice.
You're just so good looking because we're on video. The audience can't see it, but I can't help just talking with you. So last week we talked about traditional long-term care. And part of the issue a lot of people have is the premium increases like we've talked about, and the fact that it's money that goes away and never comes back. Really didn't get into refunds and things like that. But there's this new emerging area of long-term care, which we call, lack of a better term, hybrid policies that are basically approaching it from a different angle rather than a traditional premium insurance. So just sort of give me the landscape of what that is.
Well, sure thing. And I'll tell you, this is where I'm proud of our industry. We've got a lot of black marks, and we talked about it last week about some of the challenges that the long-term care planning industry has had with traditional products. This is where I'm proud. We listened to consumers who said, hey, wait a second. I don't want to pay into this policy for 20, 30 years and get nothing from it. Also, some consumers say, give me my money back. I don't want to do this anymore. I'd like my money back. And so the industry came up with these policies, I would say 15, 20 years ago, but they're a lot different than what they are today. They're more comprehensive in nature and more robust in long-term care benefit. One thing we haven't done really well is given them a name. You might read hybrid life with long-term care, asset-based long-term care, combination life, long-term care. We haven't really nailed, what we call these things. But essentially what we've done as an industry is come up with life insurance-based products, and there are some annuity ones that we can get into in a minute, but life insurance-based products with long-term care riders or additions. So win, lose, or draw, as a policyholder, I get something.
Rightly or wrongly, I don't think of life insurance as an investment vehicle. I think of it as a risk transfer vehicle. We don't have to debate whether that's right or wrong, but if we approach it from that angle, explain how one of these works. Okay, I have this long-term care risk, but I don't want to put money into something that I never see again. So just give me on a high level how that works.
And there are different types of solutions. So if I'm going to think about this big picture, macro, I got a long-term care problem. Whether I experience it with mom or dad, or I'm getting a little bit older, I'm thinking about my retirement planning. Once you've understood the risk and the consequences, there are now more ways to solve the problem. And I look at it as you've got traditional long-term care in one column, and we talked about the pros and cons last week. And then we have these life products with long-term care benefits. Then we have more permanent life insurance products where you're really buying life insurance first, and then these insurance companies added on some accelerations of death benefit riders. And then you have annuities with long-term care riders. So let's start with the long-term care solution sitting on a life insurance chassis. Let's start in that column.
Yes.
Essentially, you have individual life insurance. It could be whole life insurance. It could be universal life insurance. And then you've got a separate qualified long-term care component. Now these companies today have multiple ways to pay it. You could pay it in one shot. You could pay it over a 10-year period, 20.
That's one thing about the insurance industry. They are nothing if not creative.
Yeah.
For good and bad, both. But anyway, go ahead.
Exactly.
Multiple ways to pay.
Multiple ways to pay, but essentially, think about it as buckets of money. I've got my life insurance bucket, and I've got my long-term care bucket, and then I have the ability to have a return of premium. So in the event that I live this great long life and I die in my sleep, at age 85, my beneficiaries get life insurance death benefit. In the event that I'm not as lucky and I have a chronic ailment or some concern that requires long-term care, then I've got a separate bucket for long-term care insurance. And I dip into that bucket as needed. And if I pass away after using that money, but I still have some left, my beneficiary will get the remainder. And those are those combinations. They all, work in a very similar way. The qualifications for benefit are the same as traditional long-term care insurance that we discussed last week, where you need to be unable to perform those activities of daily living or have a severe cognitive impairment. But essentially what you've done is you've taken a traditional long-term care plan and you've dumped it inside of a life insurance plan.
And the benefit of that is the premiums that you're paying, you're at least buying a magnifier in the form of a death benefit or a pool.
You're kind of buying certainty, which, I connect to that. I like that idea where I know no matter what, I'm going to get something from this policy. And what you're also buying from a certainty standpoint is guaranteed premiums. Because this is sitting on a life insurance chassis, they're able to price it differently than traditional long-term care. So whatever premium I'm looking at is what it's going to be during the lifetime of the policy.
So it's not where they're internally buying 1-year term and the premium goes up if it doesn't perform, or?
No, you're buying a contractually guaranteed premium. And that has a lot of appeal to not only advisors that we work with, but their clients.
Okay. And then on the pool of money, so you're not dealing with, I guess you're still dealing with the daily benefit and the pool of money that you have access to.
You're designing the policy the same way from a long-term care standpoint that you would design a traditional plan. It just so happens to sit inside of a life insurance contract or sit beside it. It's a separate long-term care contract, but the triggers are the same. And then you've got the life insurance component too. And
then can you put a inflation rider on that like you would a traditional policy?
You sure can. Yeah, you sure can. So
he says very proudly, you sure can.
Well, I mean, come on. Like this nerd doesn't have much to brag about when it comes to long-term care contracts. This is the one thing I'm proud of with the industry. I shouldn't say one, but these policies really make a lot of sense for people.
Okay. And then so I'm pulling numbers out of thin air. If we have a $500,000 death benefit as an example on the insurance side, is there a percentage that is typically available as the pool for the long-term care side?
Yeah, well, let me stop you. Usually in these combination plans where there's big long-term care benefit, the death benefit isn't usually that high.
Okay.
Typically the death benefit is you're really trying to solve a long-term care problem with this type of design. So the death benefit is going to be between, $100,000 and $150,000 on average.
Okay.
And then you'll have a corresponding long-term care benefit that might be 4 to 6 times that.
4 to 6 times that.
Yeah.
So if I have $100,000 death benefit, the pool, like we talked about last week, could be $300,000 to $400,000.
You got it. With inflation protection, so the benefit is going to grow in value over time. Now, your death benefit's not going to grow. It's going to stay static, but the long-term care component is going to grow and grow.
And so the risk that the insurance company is taking, that if Roger has $300,000 worth of long-term care costs and he accesses that pool, and when Roger dies or passes away, the insurance company will absorb the $100,000 death benefit and basically eat the difference. That's their loss.
Correct.
Because it didn't pay out for them. That's the gamble or risk that they're taking.
That's right. And so from a design perspective, this is easier for me as a consumer to suspend belief that I might need long-term care one day, right? Because I've got that death benefit component, just from a psychological standpoint, it allows me not to get caught up in, I might never need this stuff. It allows me to suspend belief and say, well, I know I'm going to die, so I've got death benefit. And in the event that I do need long-term care, I now have a $400,000 to $500,000 pool of dollars that I could dip into.
And it's very easy to calculate, okay, if I have X premium with this death benefit and this life expectancy, I can calculate my internal rate of return if I live a normal life.
Some of the carriers have the IRRs or internal rates of return on the illustrations.
Okay. And so underwriting. So is this underwritten as life insurance or as life insurance and long-term care insurance?
Both. But I will say, because we're not talking about big death benefit, right? This is not your $1 million policy. It's streamlined. In most scenarios, what we're talking about is a prescription drug screen. Again, the applicant doesn't feel that. That's done in the background. A check of the Medical Information Bureau to make sure you weren't declined for something recently. And then an application and a phone interview.
This isn't necessarily something that I can't qualify for traditional long-term care, so this is an option. This isn't really that.
No, it's because they are going to look at mortality and morbidity underwriting, But I will tell you that it's a very streamlined process, and there's no exams required like permanent life insurance. It's just an application, a phone interview. And if you're over a certain age, they might do a 15-minute cognitive screen.
Okay. I've had people experience that, actually. It's interesting. So if we've got a normal $2,200 premium for a quote-unquote average policy that we talked about last week, and we don't have illustrations, by the way, that we're looking at. We're just having a conversation, and we're just using this for illustrative purposes. What is the cost relative to, say, traditional long-term care?
I mean, it's more expensive because you got two things versus one, and you've got the return of premium component as well. But if I'm going to look at like a pay to 100 versus the $2,200, it would probably be in the $3,000 range. But again, those premiums are guaranteed. That's the big difference.
So the policy doesn't have to perform. It won't implode if you pay your $3,000 a month, a year.
That's correct.
A year, I'm assuming,
that's
right?
Correct.
Okay.
A year, yes, on an annual basis. So you're going to find that they're going to be on average more expensive than traditional coverage. But what I've liked lately about the industry is that we've lowered the barrier of entry. These products, when they first came out, were single premium only. So advisors that we work with, if you were looking at low yielding CDs or money sitting in cash positions, they would move that money into a single premium. And frankly, we find that a lot of clients don't want to do that as much anymore. And so the carriers have come out with 10 pay to 65, and even pay to 100 options. And what did that pay to 100 option do? It lowered the barrier of entry. So what used to be only an affluent market product just went a little bit downstream. And people that are making good income, you still have to have money to want to protect money, but it enabled us to go a little bit more broadly into the market.
My guess would be that the earlier you're willing to pay, the lower the overall premium.
You got it. And so I'm just on a personal level, I'm looking at this right now from my wife and I. Single premium, now I'm blessed. We do great, but not that great. When I 10 pay, it would be a stretch. I don't want to change. We're comfortable with our lifestyle. I don't want to have to not do something to pay an insurance premium. Pay to 65. Hey, now you're talking. And I think that's likely we're either going to do the pay to 100 or the pay to 65 option.
And to clarify, when you say pay to 65, it means you're going to pay your annual premium and then it ends after age 65. So you don't have any more premiums.
Ideally, in your high income earning years, you're going to knock out the premium payment and then stick that in a file or an electronic file and hope you never need it.
Okay. How does someone unwind these?
Well, we don't see it that often, but the insurance companies came out with a return of premium option. And I don't know if it was originally, was it for the advisor, or was it for the client? Because when the market's going up, the advisor might want to say, hey, wait a second. We were in low yielding CDs or in cash. Now we want to put that money to work. And so the insurance companies were smart enough to figure out, let's give clients and advisors flexibility. So they all built in return of premium options. Now, in theory, it sounds amazing. I could go to somebody and say, Roger, we've got this money. It's not at work right now. I can guarantee you death benefit and long-term care benefit. I can guarantee that the premium is going to be the same. And oh, by the way, Roger, if 5 years from now, if 10 years from now, if a year from now, you tell me you want to quit, I'll give you your money back. What we found in practice, theoretically, that's what can happen. And the amount of return of premium varies from company to company. But in practice, we don't see it. People aren't asking for their money back.
I don't want to call it a marketing ploy. Because it's not crass. It's just a way of making it palatable because let's face it, insurance is not something any of us really want.
I'm an insurance guy and I don't even want to buy the insurance.
Right.
I'm not even having fun during this process analyzing it all, but I like the fact that I've got that flexibility.
And having a return of premium option really increases the premium.
No, it's built into the contracts themselves. So there's no additional pricing for that return of premium.
Really?
Yeah. And the way the insurance companies are able to do that is because it's not utilized often. Now, if it was, then I'm sure they'd price it into the next generation of product. But it's so seldomly utilized that they just built it in.
Interesting. And then the way that, and if you had to turn on the long-term care benefit and access your pool, then it's really going to act exactly like a traditional policy in terms of the everything we talked about.
Exact same way. And there are even some companies out there that will, instead of reimbursing agencies like we talked about last week, that will just pay you a cash benefit on a monthly basis.
I know there are companies that offer this, but is this mainstream or considered sort of in the, well, we might do that? And it's...
No, these are mainstream. I think the insurance world has recognized that healthcare is front of mind for people. We're on this conversation today because healthcare is a big part of retirement planning. And if you drill down a little bit further, long-term care is probably the biggest healthcare expense that somebody may have in their retirement years. So these insurance companies got wise to that and said, let's build products that will address this need. And many of them felt more comfortable building these products on a life insurance chassis more so than a traditional chassis.
As someone gets older and they have less need for death benefit because the kids are grown and their house is paid off or whatever, is this something that you can repurpose current life insurance policies to?
If you have a traditional life insurance policy, like a permanent life insurance policy,
permanent,
there is a way. And if you have cash value that's built up in that policy, you could do what's called a 1035 exchange, where you take that built up cash value on a tax-free basis and move it into one of these combination life long-term care plans. So we see quite a bit of that activity as well.
Okay. I'm just thinking through that because a lot of people are figuring out what to do with those policies. You mentioned that there's also an annuity chassis.
we talked about traditional last week. Then you have these combination plans. Then you have permanent life insurance with chronic illness or accelerated death benefit riders. That's where you're buying life insurance first, and then the companies have added on these riders where you can tap into the death benefit. But really, that's I'm solving a life insurance problem first type of products. Those are out there, and those are growing in terms of people buying in the marketplace. But then you have these annuities with long-term care riders. They're typically single premium annuities.
Okay.
Where you give the insurance company $250,000, and then there's a multiplier in there. If you need long-term care insurance, then you can, tap into, $10,000 a month of benefit. Right now, we haven't seen that in terms of the marketplace. We've seen more of the life insurance component products growing more so than annuities, typically because of interest rates. You just get more leverage on the life products today than annuities, but essentially they're single premium annuities that have a long-term care component or rider that will just throw off cash in the event that you need long-term care.
Yeah, I imagine with a single premium annuity, assuming it's not variable in any way, yeah, the insurance company can't have a big multiplier because they're not making any money on the money, which is what they do.
Until interest rates creep. Now, once interest rates start creeping up again, whenever that is, I do think we'll see more growth in that segment of the market. Right now, most of the growth has been in the life insurance component. And it's been really interesting. As an industry consultant that's been around for a long time, I've seen the market kind of flip, where 10, 15 years ago, traditional long-term care was 80% of the market. And then the industry had its challenges. And at the same time, the life insurance industry really evolved and built these better life products with long-term care components. And now about 80% of the market is life products with long-term care riders, and the rest being traditional.
Oh, really? That's 80% of it now?
Yeah, it's 80% of it. And when you look at, when I informally talk to life insurance companies and say, hey, what percentage of your business have some type of long-term care component? They'll tell me between 30 and 50% of their business now.
And you use a phrase, and it's an insurance phrase, I think, from a compliance standpoint. You're solving a life insurance problem first. I imagine a lot of people are sort of using that. I'm saying individuals wanting them really to solve the long-term care policy in a way that's palatable to them more than.
That's correct. And contractual language is important, and the benefit triggers are important. And that's why you have to be careful and spend time looking at, the different products to determine what might be the best fit. But some products look and smell and feel and act like traditional long-term care components inside those life products. And some products are, require a permanent disability. And you can't call it long-term care, but it kind of does, provides for chronic illnesses. So it's kept us busy as consultants, kind of sifting through the different product variations to help people select the right insurance contract.
So in this hybrid world, let me restate that and see if I understood this correctly. The long-term care portion of it is not as standardized as if you bought. You have to understand what they mean by what in the rider.
Well, it's so interesting. If you have a qualified long-term care rider and it's a specific tax code or section of the tax code, then that looks, smells, feels, it is exactly the same as traditional long-term care. And then you have other life insurance products that don't have that rider, but they have an acceleration of death benefit rider or a chronic illness rider, and how somebody trigger benefits might be a little bit different.
That's how you can manage the pricing, because they may seem more attractive on the front end, pricing wise, but the devil's in the details on the definitions.
You got it. And ultimately, it just comes down to good consulting and fact finding, where we sit down with somebody and say, what are we trying to accomplish here? Like, what's important to you? And usually if it starts out with life insurance, then that's the direction it's going in. If it pivots to long-term care or starts there, we're really looking at a qualified long-term care rider on a life insurance product or a traditional product.
You have been extremely generous with your time. And I just have one more question for you, but I'm not going to hold myself to that. Who needs long-term care? I'm thinking of this the perspective. You have a good group of people that just can't afford it. You have a good group of people that have to price a policy to what they can afford. And then you have people that could likely self-insure, and it would hurt if it happened, but it wouldn't be devastating. So who really needs it?
Let me answer your question. Not everybody. I'm a proponent of long-term care planning And sometimes you utilize insurance as a vehicle, as part of that planning, and sometimes you don't. So to your point, an affluent person or somebody with multi-generational wealth, they could certainly self-insure. Those are the folks not, knocking down our doors. I've found that the way these products are priced, it is unfortunately become, or it has become, kind of an affluent market product. Whether we're talking about life with long-term care or traditional, who needs it is the mass middle, but they can't afford it the way it's currently priced, and it is priced to be more stable than it was in the future. So we're at this tough place where we've done a great job as an industry upstream with affluent clients. We've got multiple different ways you can plan using insurance, multiple products that I think are competitive and will do the job, but it's not for everybody. So I just tell people, I want to make sure that you have a plan for long-term care. Sometimes that's insurance. Sometimes it's a yellow legal pad. Sometimes it's having a conversation with your son or daughter. But I just want to make sure people are planning.
I always tell myself, this is not true, but I always say my long-term care plan is adult children that are successful that like me.
Man, I am that. And my mom lives 5 miles away. And it's probably been the toughest year that I can think of in terms of helping care for mom, coordinating that care. And I'm an insurance guy that didn't do this planning with mom and dad, and now it's too late. And so, conceptually, I get it. And my mom and I have a great relationship, but the caregiving piece is hard. So I just tell people, talk about it with your family members, plan for it. Sometimes insurance makes sense, sometimes it doesn't.
Thanks so much for being so generous with your time.
Thanks, Roger. Take care, everybody.
So we've been talking this month about financial implications of long-term care and how do we go about making a decision of whether to take on the risk or transfer the risk via insurance in other ways. So what I thought I'd do is bring on our head retirement coach for the Rock Retirement Club for Coach's Corner, Kevin Lyles. Mr. BW, how are you, sir?
Doing great, Roger.
We're going to pivot a little bit, right? We're going to talk about what to do when you found yourself thrown into the role of caregiver.
Yeah, that's right. Long-term care, the financial implications you've been covering this month, but I really think this is an area where they're not as great as the personal and emotional and relationship issues.
I think that's definitely true. I think later this year, we're going to spend a month on the parent project because that's typically who you start with.
Yeah, it sure is. I mean, that's the first caregiving role many of us are going to face in retirement, is helping out one or both of our aging parents. That's really a broad topic to cover, as you know, because there are so many different issues can arise. One is depending on where your parents live. They might live in the same community with you. They may be across the country from you. Maybe a single parent's going to move in with you. So each of those situations come with its own unique set of challenges. Similarly, are you still working? And if you're still working and you need to take on a caregiving role, it can really affect your own financial success at retirement because you may have to leave the job and income that you had planned. Another complicating factor with parents is siblings. Do you have siblings? Where do they live? Are they willing and able to help out? And it can really affect relationships between siblings.
Well, siblings always get along, don't they?
Well, let's hope so. This can either bring them together or push them apart. It's a real challenge, I think, sometimes.
So real briefly, I guess, what is a step to at least have it on the radar? I mean, maybe somebody's dealing with it right now, or they foresee dealing with it in the near future to start to frame how to navigate this.
Yeah, that's so important, is to get the family together and talk about the issue. This is one of those issues that none of us like to think about, but usually your parents want to have the conversation and don't know how to start it. So I suggest getting your siblings together with mom and dad and really having a conversation and talk about what planning mom and dad's done, talk about the ability of each of the siblings and children to help out, and try to come up with a plan in advance of the need for care. That will put you in a much better position, I think.
Well, I imagine a really good place to start, sort of to come in sideways, is to do something like what we're doing in the Rock Retirement Club with Everplan, in organizing all of our documents and having this in case of emergency plan, because that conversation would just naturally come up as part of that.
I think that's right. I think as you're coming up with your own plans for your own life, it's an easy opener to talk to your parents about, hey, do you have things in place? Do you have a will? Where is it? What are your wishes? And really have those conversations up front rather than being hit with a crisis and then having to deal with it when everyone's in an emotional state.
I wonder if another way, because I remember seeing a checklist at one point of how to, because most people want to age in place, I think is the term, right? They want to age in the house that they're in. They don't want to have to move. So I wonder, one way is a checklist I saw that was how to prepare your home to be able to age in place. I mean, if you're at a tri-level, it might be a little difficult. It might be clear that you can't.
Absolutely. And that's, in a lot of people's retirement plan, downsizing, but really it's right sizing to get to a home that you can age in place in, or remodeling your current home so that you can. That's an important consideration. I know a lot of children will look to remodel to where they've got a convenient place to bring mom or dad in if that becomes necessary into their home, and having that so that the parent can have some privacy and yet be at the children's home where they can be assisted if needed.
And I imagine that's a large part of the navigation is helping them. The term that comes to mind is save face or keep their independence and not feel that they're a burden. So they can feel like they're living in a separate mother-in-law suite with, their own kitchen and things like that can help them feel independent, but still be nearby.
That's absolutely right. You want them to have as much independence as they're able to handle. That gives them dignity. And that's an important, that raises another topic here. And one of my tips for caregiving is you've got to have a conversation between the caregiver and the person being cared for so that each of you can express your feelings, set mutual expectations. You don't want to have one person wanting one thing, the other thinking they want the other. Just have some open communication with your loved ones.
Lots of little conversations.
Absolutely.
Well, next month on the show, we talk about how to decide where to live in retirement. And so some of this may get wrapped into that, because deciding, whether it's one of those continual cares or when do you actually start to even think about this. So we'll probably chat about this again.
The second type of caregiving that's very common is caring for your spouse. And that's really where the living arrangements become important, because while you might want to stay in the bigger home, it may be much more difficult for one spouse who's taking care of another. And so it's just another issue. We've seen the studies that really show that caregiving can undermine physical and mental health. And so the first tip for caregivers, take care of yourself first. If you're not healthy, you're not going to be a good caregiver. And that's both physical. So take time to exercise, make sure you're eating right, getting sleep. But psychological well-being is just as important. It can really be an emotional roller coaster, really, for the caregiver. You go from feelings of love and connectedness and accomplishment to feelings of frustration and resentment, helplessness, and sometimes depression. So really take care of yourself first. You're both your physical and emotional well-being.
Yeah, that's an excellent point. In that long-term care statistic, 1 in 2 will need some type of long-term care. I forget the exact number off the top of my head, but it was 70-80% are done by a family member, typically the spouse. And it's easy to stop your life and just become a caregiver full time. And I imagine what you're talking about is you need to find that balance between still doing the book study, still doing the activities that you want to do for yourself, and not just simply suspend your life and totally focus on the other person.
That's right. That's one of the common complaints, is probably not the right word, but frustration is retirees feel like they've had to put their retirement on hold to take care of mom or dad or another family member. And so that's why I really like you spending the month you're doing on long-term care and the financial issues, because if you can have a good plan in place, it can free you up to where you can enhance the relationship with your loved one, but still live your life.
Excellent. And probably get better care.
Absolutely. It's when you don't have the financial resources to take care of it that it really becomes a strain, both for you financially, but also emotionally.
Excellent points. BW, I appreciate you as always.
Talk to you next month, Roger.
All right. I'll see you in the club. All right. Well, let's answer some listener questions with Nicole, Rockstar Mills. Nicole, are you warmed up?
I am warmed up. I think our little practice there was really good.
You did a tongue twister that I had not heard before. Will you do it for us real quick?
Sure. How many Lowe's would Rob Lowe rob if Rob Lowe could rob Lowe's? Now you do it.
I can't do any tongue twisters. That's probably my problem. You can you do another one because you're pretty good at them.
Peter Pepper picked a peck of pickled peppers.
Bam. One more.
Sally sells seashells by the seashore. Like,
I need.
What are some other ones?
That needs to be what I practice. I need to practice that stuff. Maybe we need to get Tracy back here, the voice coach.
Yes.
I think it's my sinuses. I think it's my sinuses. Anyway, enough about us. This show is not about us. It is about, well, you and your ability to rock retirement. And we have a few questions, Nicole.
We do. Our first question today comes from Robin, and she's writing in asking about annuities. One of your favorite topics, I know. She says, I have a question about annuities that we currently own. My husband is 62 and I'm 59, planning to retire at 62. We both bought a variable annuity with a 7-year surrender period where we're paying higher fees, and I understand that we'll fully own these at the end of 2022. Both annuities have death riders on them. As all annuities are, I know they're a bit confusing and complicated, but as I'm listening to your podcast and other retirement podcasts, I'm learning that many advisors aren't fans of variable annuities and recommend maintaining a balanced portfolio to accomplish the same goal. My question is, should we consider getting out of these and they mature in 2022, or do I suck it up and turn on the income when we decide to?
Well, that's a great question. And the answer is always, I don't know. But let's think through how you might answer this for yourself, Robin. So the decision point is going to be, we'll call it 2022 when the surrender period ends, right? Up until then, you're going to have friction if you were to surrender it because you're going to have a back-end sales charge, essentially. Now, we'll put aside the argument of whether it's even worth that to get out of the higher fees and whether you would net be better off later on. But what you want to do between now and then is start to create an overall strategy so you can evaluate why you have these assets in that annuity in the first place. And it's less about a product because annuities, and if you recall, what month was it last year, Nicole, that we did the annuity series?
I think it was September.
Annuities aren't necessarily a bad thing. They just have a place. I think the important part is answering the question, why are you invested the way you are in the first place? And it sounds like you're questioning that in regards to the annuities. And generally, it ends up being product first. And it sounds like that might have happened. Either someone sold you or you had a fear of the market or a desire to have some income guarantees that the annuity offered. So you purchased the product. And I think ultimately, we're going to have to reevaluate, does it give you the greatest chance to meet the goals that the two of you have? And this is what you're going to have to answer in 2022. And I think a good way of going about that is to use a process that will give you, well, why are we allocating our assets in the first place? To what end? In our world, that's going to be to create the cash flows to support your life with minimal risk of it having to deviate. And then coming up with a strategy, sort of the overarching, how are you going to go about approaching this? And then the tactics, which is, okay, what products should we use to execute this strategy? And the product is going to be whether it's annuity, whether it's going to be a balanced portfolio, as you talk about. Generally the knock on annuities are they're very easy to get into and very hard to get out of. So you lose a lot of optionality, and you're experiencing that because you feel stuck now. The other knock is that they might have much higher fees than what you might be able to execute on your own, whether with passive investments or with ETFs or something. And two, for the same fees that you're paying, you could likely get really quality advice. And if you're going to pay those fees, it's probably better spent on having someone guide you and work with you rather than paying the investment or the insurance company. So I think in 2022, you have to evaluate, because there are benefits to annuities, as we discovered in September, right?
I was actually wrong. I just looked it up. It was July of last year.
Womp, womp. That's 2 months off. Holy cow, Nicole. In July, there is value to be found in annuities, whether it's to build a guaranteed income source, you're buying yourself a pension, or whether it's to give yourself a pension in the event markets go the wrong direction. And it's up to each of us to evaluate whether we need all of that to achieve what we want. And I think one big thing that came out of July's annuity discussion was part of the value of having a quote unquote pension that you can turn on is so you can make decisions for yourself later in life when you're potentially don't have the energy, the interest, or the mental capacity to really want to manage a balanced portfolio. So I think, Robin, the way you want to approach this is, okay, I got a 1.5 to 2-year timeline to find my why and create an overarching strategy, and then let the strategy lead to the tactics. And I think that will help you figure out whether the annuity really makes sense for you. I don't know from a cash flow perspective where you and your husband are. Is this providing income for early retirement or late retirement? And then is this the right annuity to do that if you want annuities at all? Generally, I do not use annuities in my practice, mainly because I believe in an agile approach and I like a lot of optionality, and I like to be as conservative as I can be in the fees that are spent. But I wouldn't just say they're good or bad. It probably may feel like a bad decision right now. I think the key is let's not make a decision from those eyes. Let's reevaluate it with fresh eyes to see what is going to position you to achieve the spending goals that you and your husband want based on the kind of priorities you have, and let that decide whether the annuity is really a good idea or not.
If it helps, I can throw the links from last summer's annuity series into Six Shot Saturday too.
And I tend to have a bias against them, and I think I still do.
Yes.
I think I still do, but I think of them critically. They're just a tool that can be very expensive and very restrictive.
But we did one of the episodes last summer was BW, our retirement coach from the Rock Retirement Club, has an annuity, and he's really happy with his decision to have one. And we actually have an interview with Roger and BW talking about that.
Yeah. Yeah. And he has a different type of annuity than a variable annuity.
True.
Which could be a decision point in 2022. And I think the key here is between now and then, you're going to want to have a framework for making a good decision for the two of you. That's more important than whether the annuity is right or wrong or good or bad, high fee or low fee, because those are going to be subservient to what positions you and your husband for success, given the spending goals that the two of you have. And this is something we're exploring, and this is not an advertisement by any means, but like the next module that we're coming out with next month for the master course is on agile financial planning, how to implement that framework. And part of that, we're going to be reviewing tools that we use to make decisions. That's something that might be helpful is, what is a framework to help you make a better decision? Because ultimately that's what we're all trying to do, is make lots of little good decisions. And I think there are frameworks that have been developed throughout the years that help us get to better decisions, sort of like the risk framework that we talked about last week.
You ready for Mary's question?
I am ready, Mary.
You are ready. Okay. Mary says, my husband and I have been loving your podcast.
No, the first thing she says is what?
First thing she said was, hi, Nicole. So hi back, Mary. We're in our young 50s and listen to your podcasts separately. I would love to hear more on how couples handle differences and how much stuff you keep. Kids stuff, work stuff, financial stuff, extra clothing, abandoned hobbies, school-age mementos, etc., etc. I haven't heard all of your podcasts, so maybe you can point me to a previous one, but this is a topic that many people my age talk about. Thanks for your podcasts. It brought structure and thought to our retirement planning. Good job, Roger.
She said, thank you, Nicole. Good job, Nicole. Stuff.
I was hoping it'd be better by young 50s, but it sounds like maybe not.
Well, and this is going to be talked about. So next month, just a week from now, we're getting into a month of where to live in retirement. And we're going to look at it a little bit differently because we've covered this topic before. And we'll link to those shows and some of the show notes of how to choose locations and everything else. Because where to live might be right where you're at, right? But the hard part is, Mary, and you're experiencing this, it's like clothes, it's like mental models and making decisions. We collect them and hold on to them forever, sometimes very far past their use-by date.
I'm looking around at my desk at like fingerprint artwork from my kids' preschool years that I haven't found places for. And yeah.
And it feels, well, let's use the fingerprint art, right? I think I have a few boxes in my attic of Emma's epic artwork. In fact, I'm looking at a wall that's an octopus that is huge and I just can't get myself to paint over it. We collect these things and you don't want to lose the memories, one, but you also don't want to lose things that you would love to pass on to your children, because that's how stories are told. So in decluttering, and then you have two spouses, one is maybe leaner in terms of clutter than the other. And that sounds like that's what you're talking about. So we're going to dive into how do you reconcile that together. I'll tell you one great way to declutter your attic is to get a rat infestation. We decluttered significantly after we discovered that because rats urinate everywhere, evidently. So our attics are very clean. So that's one way, but I don't suggest it. So Mary, I guess tune in next month because we're going to start going through this, because deciding where you live, even if it's, the decision can be, we love where we're at right now, but you can still reimagine your current space. And we've done that with our house, and decluttering and coming to some agreement together on decluttering to design that space together is a key part of it. It's a good question.
I was reading that Organized Mind book, and one of the things that I thought was sort of funny that it mentioned was that when looking at clutter, women's cortisol levels actually go up, but men's do not. So that I kind of got a chuckle out of that. Mary, hopefully your cortisol levels are doing okay.
Which is implying that the man is the clutterer.
I don't know that that's necessarily true. I think, it's just different brain wiring.
But you have to get to some reconciliation as a couple if there's a mismatch, yes, right? Yes. And it's not I'm right or they're right. It has to be how do they get what they need?
Compromise for sure.
There's that concept in negotiation. Like there's positional arguments. I like my stuff. I want to keep my stuff. Right? Why? But then there's really what it means to them. There's usually another layer below the position of I don't want to get rid of my stuff of really what they want. And I think it's important to try to tease that out to understand really what the desire or issue is.
Psychological meaning.
No, there is, right? There's, I'm trying to think of a good example here. Oh, I'll use a great example. Dan Miller, a good friend of mine who is moving, getting ready to move, and he has a extensive library. His clutter are books. Nicole, you got to go visit Dan. Oh, his clutter are books. I mean, he just loves them stacked around him everywhere. And he's written a number of books and he knows tons of authors and people send him books all the time. So he is like,
I want to be friends with Dan Miller.
And he's gone through this because they're getting ready to move, of reconciling his library of books. Most of them he's read, but most of them he hasn't read in years. And his big deal is 48. He wrote 48 Days to the Work You Love. 48 is a very meaningful number to him. So he's been trying to cull his books down to his 48.
Oh, I like that.
And it's been difficult, but I think I'm always impressed with him. And Dan is like 71, by the way. I've always been impressed in his ability to evolve and become the next version of himself. And part of this for him has been culling out the book herd down to a manageable size in preparation for the move. And as I've talked to him, as he's gone through this process, it's like discovery. It's like if you go look at your kids' art. Oh, I remember when Henry did that or this. He's rediscovering books, but really having to make decisions about them. So it'll be an interesting topic.
Our next question is from Michael. Michael says, my question is around evaluating my portfolio manager and knowing when to fire them. Ooh. My advisor's advice has been great over the years, but I continue to be concerned about the overall performance of my portfolio under his company's watch. Do you have any thoughts or benchmarks you use in evaluating the performance of portfolio managers? And how do your clients or listeners handle portfolio managers and holding them accountable to decent returns?
It's a good question. So let's define our terms here first, right? So there is a financial advisor who helps build the overall strategy. And when we're talking investment management, generally that's the asset allocation. And then the advisor and his firm traditionally will do a search and selection process to find portfolio managers to fill the different slots of the asset allocation, right? So if you have a pie chart and it's supposed to be 20% large cap growth and 20% large cap value, then the advisor and or his firm will go and try to find the best manager to fill the large cap growth sleeve and the large cap value sleeve and so forth. That's traditionally where a lot of the focus of financial advising has been for decades. And the goal of filling the sleeves is to build an efficient portfolio to help you achieve whatever the objectives are. And some advisors really get into life objectives, sort of like we do. Some get into more long-term growth or, growth with income and time frame objectives. What you're talking about is how do I evaluate? My advisor's been doing this, hiring these portfolio managers, whether it's a mutual fund or a separate account manager and so forth. How do I evaluate whether those managers are doing well enough for the extra fee? Because if you have the investment firm, you have the financial advisor, and then you have the portfolio manager hiring, you're layering fees on top of each other, right? And ultimately you want to pay a fee for value that you believe you're going to receive over and above the fee that you're paying, right? That's how we allocate capital. So you want to make sure you're a good steward of your fees. So let's talk about the role of a portfolio manager. So a portfolio manager's role typically is to, if it's a large cap growth manager, it is trying to beat its relative index, because a portfolio manager generally will benchmark, which means compare itself to its particular sleeve or index. So if it's a large cap growth, we'll just say it's comparing itself to the S&P 500. And then the manager is going to try to beat the S&P 500 or add alpha, which is a portfolio management term. It's going to try to beat the S&P 500 through security selection. So the logic behind active portfolio management is I can pick better stocks than just the index. That's number one. So it's through stock selection. And number two is they generally try to beat the index by overweighting some sectors or underweighting other sectors. So as an example, let's just say the information technology sector of the S&P 500 is 15%. I don't know what it is off the top of my head, but let's say it's 15% of the index. And if the portfolio manager is going to first make a decision, do I like information technology right now, given blah, 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 blah? And if they do, then they'll overweight above 15%. Or if they don't, they'll underweight below 15%. Because they think it's, say, overvalued, and then they'll try to pick the best stocks within that sector, and then that's how they build their portfolio. The short answer, I think, is if that's the structure of the portfolio management, it's a waste of money. Because, one, it's structurally designed not to set them up for success. Because, one, they're tying themselves to a benchmark. Two, the way they design the portfolio is designed to almost match the benchmark. A lot of portfolio managers, for the most part, if they're supposed to compare themselves to the S&P 500 and they don't like the information technology sector, and if the S&P 500 is at 15% of the sector, the way they would express not liking that sector would be go to 14%. It's a game of inches because they don't want to deviate too much from the index because they're trying to match the index. So if they hated every stock in information technology in this example, most portfolio managers can't just not own the sector. They're going to have to own a percentage of the sector, probably pretty tight to how the S&P 500 is set up for success. And so I think the whole structure is set up for failure because even if they can do all of these things, it's in such a minuscule way that it's almost impossible to overcome the fees that they're charging in order to do it. And statistically, it proves it out. Most managers don't beat their relative index. You're sitting there and your question is a valid one. How do I like my advisor. He seems to do a good job, but the performance doesn't really do much for me. How do I evaluate this and know when to fire them? That's a whole quote unquote art in itself. But the problem is then you're going to go through a search and selection process and find a manager that may look better right now. But the problem is all we care about is predictability, which is almost impossible to judge with active management. So let's get back to the question. Why are you invested the way you are? The only right answer in my mind is because the portfolio gives you the greatest chance of meeting your goals, right? That is the right answer. Whatever your portfolio should be, it should be designed to help you reach things that are actually important to you and your family. So if that is really the only right answer, then we have to ask ourselves, what levers do we have to position ourselves to reach our goals? It could be asset allocation, it could be cash flow planning, it could be financial planning, it could be manager search and selection, it could be fees, it could be taxes. You want to identify all those levers, and then you want to look at the levers and say, which ones will have the most impact, which ones won't. And over my 30 years of doing this, choosing great investment managers is one of the smallest levers that will likely have very little to no impact on reaching the goals that you and your family care about. So why spend the time or the fees going through all that exercise? Why not focus on the bigger levers, the pie cake, the cash flow planning, the tax planning, and all those other things? Hopefully that gives you a framework, Michael. I'm sure we'll do a deep dive course in the club on how to evaluate a portfolio, but it's a pretty high bar. A book I would suggest that you read is Winning the Loser's Game by Charles Ellis. That talks a little bit about this inability of managers to beat their indexes, mainly because they're just set up for failure because of fees and taxes and things like that. Let's not spend so much time focused on that stuff, and let's focus on the process, the strategy, and the tactics. What manager you use ends up becoming really simple. Do you think that answered the question there?
Oh, I think so.
It
was a more complicated answer than I expected, really.
Well, I think you go back to the fundamentals, and I think this is one of the biggest problems with financial planners and financial advisors is I grew up all about investment management, finding amazing managers, putting them into the asset allocation. That's what we grew up with. I've moved on from that as what we do, but I think that's still the core of our industry. I think I mentioned this last week. I've had a few conversations recently. Man, when I meet with my advisor, all I want to talk about is how the portfolio did relative to the markets and where they think the economy is going and all these other things, which has nothing to do with positioning yourself to reach the goals that you care about in your life. So I think there's a huge disconnect that our industry hasn't solved yet. Okay, soapbox put away.
Off soapbox.
Off soapbox, stage left. Sorry about that, but it's important.
It is.
We just did a whole show right here. It's going to be a long show.
You make all kinds of money, but if you don't have a clear plan for what you're trying to do with it, then...
Yeah, and you don't want to focus on levers that are not that important. The fact that your son's shirt doesn't match his pants when he goes to school Sometimes we can.
Not as important as the fact that he dressed himself.
Exactly. That's the bigger. You go with that style, buddy. But sometimes we focus on these things that really are inconsequential to the end goal that we really want, because we forgot about the end goal because of all this other crazy cool stuff going on. So, all right, I guess we better
We better go to the smart sprint.
On your marks, get set.
And we're off to set a little baby step that we can take in the next 7 days to rock retirement.
You're like sprinting through the sprint.
I'm going to make that a tongue twister. That's its own tongue twister. So in the next 7 days, although we're closing out, I guess we should talk about closing out this long-term care risk discussion. So in the next 7 days, if you haven't already, evaluate this for yourself. Go through, do you self-insure it? We know you can't avoid it. Are you taking any pro actions to mitigate it? Like Dr. Mark Milstein talked about, and then evaluate how much you want to share it and then go find the solution for you, or at least schedule a time to go through this process so you can make an intentional decision about it. That will make you, or bring you at least some peace that you actually addressed it. So, Nicole, you warned me that if we asked for feedback, especially regarding grammar, that we would get some.
If you build it, they will come.
So we had an anonymous listener kindly tell us, so what was it about the disclaimer?
That we don't have it worded correctly on thank you for listening. And now I'm struggling to remember because I don't have the email in front of me. I think it's supposed to be, he said it was supposed to be thank you for your listening instead of thank you
for listening.
For listening.
I think it's in the canned exit one, right?
It is.
Yeah.
It is in our canned exit.
I think we're just going to let that one pass.
We'll redo that eventually one day.
Yes. We're in the middle of rebranding our firm, right? We have a new name for our firm. Maybe we can make sure this is grammatically correct. It's Agile Retirement Management.
I think we nailed that one.
I think we got that one. Well, all right then. Next week, we're going to dive into how to decide where to live and how to organize it. So that'll be interesting.
And in the meantime, just thank you, listeners. How about that? That's grammatically correct, right?
And don't take advice from us. Talk to your legal advisor, tax advisor, or your financial advisor, because that's just common sense. Have a great day.
We appreciate you joining us today for this episode of Retirement Answer Man. Be sure to visit rogerwhitney.com/answers to access the Retirement Answer Library with over 30 checklists to help you make the most of the only life you have. Remember, you have more power than you realize to create an amazing life starting today with Retirement Answer Man. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and no guarantee of future results. All indices are unmanaged and may not be invested into directly. Have a wonderful day.